reached the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem, let's grow wealth for you.
You've reached the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem, let's grow wealth for you.
Yes, I just paid my children's school fees. Supposed to buy some shares today, but it's school fees season, you know.
But just like school fees, stocks cannot wait. Life's many responsibilities come with its sacrifices, but with the margin lending facility, you don't have to miss out on your investment opportunities. Now you can buy shares even when you are not liquid. All you need to do is have existing shares, managed funds, or cash to be used as collateral. The marginable stocks will be calculated to determine how much you can get to buy new stocks. Remember, there is no investment without risk. The time and stocks wait for no one. Don't imagine what can be. Let the Meristem Margin Lending help boost your investment portfolio. Terms and conditions apply. Call 0700 Meristem now to get started. Meristem, let's take you further.
Yes, I just paid my children's school fees. Supposed to buy some shares today, but it's school fees season, you know.
But just like school fees, stocks cannot wait. Life's many responsibilities come with its sacrifices, but with the margin lending facility, you don't have to miss out on your investment opportunities. Now you can buy shares even when you are not liquid. All you need to do is have existing shares, managed funds, or cash to be used as collateral. The marginable stocks will be calculated to determine how much you can get to buy new stocks. Remember, there is no investment without risk. The time and stocks wait for no one. Don't imagine what can be. Let the Meristem Margin Lending help boost your investment portfolio. Terms and conditions apply. Call 0700 Meristem now to get started. Meristem, let's take you further.
Hello. Good morning, distinguished ladies and gentlemen. Can someone just confirm if you can hear me?
There's an echo.
Okay, is it better?
Okay.
All right, thank you. Okay, once again, I'd like to say good morning, everyone, distinguished ladies and gentlemen. We must say it's a privilege and honor to have you as our guest this morning. And on behalf of the entire Meristem team, we want to say you're welcome to this webinar on our outlook for the second half of 2022. And these we have titled Unearthing Value in an Unending Crisis. No doubt, we all understand the current economic challenges our country, Nigeria, currently faces. However, we've seen how the first half of 2022 has panned out. Yes, it's been full of clangs, it's been full of chatter, but we can say to a large extent, some degree of gains were made. And so first half 2022 is history. And now the focus for investors is for the second half of the year, which we have found ourselves. And it is obvious that pertinent questions about the direction of the economy for the second half, as investors, you are considering what choice of asset classes do I put my monies in or my investments in? What degree of restructuring to my existing portfolios do I have to make, all in a bid to maximize gains? These are pertinent questions that investors will be asking. But for us in Meristem, we believe that amidst this crisis, there is value for grabs, you know? And so this morning, for the next 60 minutes thereabout, we'll be providing insights. We'll be providing our outlook for the expectations for the second half of 2022, which will cover both the global and domestic economy and markets. And so we've put together, to do justice to this conversation, a panel of esteemed research analysts. And I want to urge you to be steadfast, be attentive, because the next hour promises to be worthwhile. Also, I want to urge you to ensure you drop your questions using the question and answers tab on your screen below. Kindly make use of the Q&A tab to drop all of your questions, and they all will be dealt with at the end of the session. And as we set sail, I'd like to introduce our first panelist, who would be taking us through the markets, the macros precisely. She's no other person than Mosumola Adeoye. She's a senior research analyst with Meristem Securities. She focuses on the macroeconomic research. She covers the agricultural sector, and she'll be leading the first conversation, giving us an insight, an overview, and our outlook rather, for what the macroeconomic environment looks like, both globally and domestically. So Mosumola, the floor is yours. Thank you.
Thank you, Moefe. Good morning, everyone. So I'll be taking us through the global and domestic markets in a short while. All right, next slide, please. Okay, so here we have the key highlights of the global economy. And on world GDP, we saw that coming into the year, we expected that the potential outbreak of the new variant of the COVID-19 virus would be the major threat to the economic recovery that was witnessed last year, that was in 2021. But then by mid-February, the war in Ukraine already escalated this concern. And for context, we saw that the US recorded a decline in output of 1.6% year-on-year as of first quarter of 2022. And the UK also recorded a much slower growth of 0.8% year-on-year increase, as against 1.3% year-on-year earlier recorded. I mean, all this just points to the fact that much of the global growth for the rest of the year depends on resolving the Russian-Ukraine crisis. A lot of these countries depend on these warring economies for critical inputs. And already IMF has lowered global economic growth 3 times this year, with the most recent being this week, lowering it from 3.60% to 3.20%. And on global inflation, much of our expectation for global GDP also feeds into our expectation for global inflation. And we've seen that IMF already forecast inflation to hit 6.76%, which is a 7-year high, as against 6.40% that was recorded last year. And some of the factors for these high inflation figures are the sanctions on Russia, the persisting war in Ukraine, the COVID-19 pandemic, emergence of new variants, as well as supply chain disruptions. So moving to the monetary policy aspect, we saw that a couple of the monetary authorities that are earlier regarded inflation to be transitory are already aggressively hiking rates in a bid to curb these soaring inflation figures. And we do not expect this to recede for the rest of the year. We expect further hike in rates. The fiscal authorities, we already saw that as we came into the year, there was a reduction in fiscal spending, mostly due to the modest pace of economic recovery since last year. Well, going into the year, especially with this Russian-Ukraine crisis, we can see that there is increased borrowing costs, and as such, fiscal support is expected to be largely muted for the rest of the year. Okay, so that's a brief summary of the factors that set to impact the global economy. And now we move on to the domestic economy. So on the chart to my left, that's the first chart. What we have there is the sectoral growth rate, non-oil sector, oil sector, and then the overall real GDP growth rate for Nigeria. We can see that despite the ongoing geopolitical crisis, the resurgence of COVID-19 cases in China, and even recession fears in some other countries across the globe, Nigeria's household growth still remains positive. And as at Q1 2022, it hit 3.11% year on year. So we attribute this to continuous support from the non-oil sector. This sector has actually benefited so much from the fiscal as well as the monetary authorities. On the other hand, the oil sector, output from that sector declined, continued to contract, and this time around it contracted significantly by 26.04% year on year. And this is the worst contraction that we've seen since 2010 when NBS started tracking this data. We can attribute this to largely, production volumes, issues with low production volumes, especially crude theft. There are diminishing investments in the sector. We see the likes of Total Energies divestment. Well, as such, we do not see any significant improvement in production volumes for the rest of the year, so we expect it to hover around 1.6 million barrels per day. For non-oil sector, on the other hand, we are quite bullish. We expect sustained interventions from the monetary authorities too, and as well as the fiscal authorities to keep propping the non-oil sector. So on the chart to my right, we have the sectoral contributions to GDP growth, and we can see that the ICT sector was the main driver of the growth that was witnessed as at the first quarter of the year. This is largely due to increase in subscriber base as well as the surge in data traffic, especially with this 4G expansion. So overall, we expect Nigeria GDP to still grow by 2.51%, which was our initial projection. And but some downside risks to this forecast include the fact that we already have consecutive rate hikes by the monetary policy authorities, and this would impede on economic growth figures. Also is the fact that there are issues around low production volumes for crude oil. So what we have here is our inflation as well as policy expectations. And on the chart to my left, we have a fan chart that shows different scenarios for inflation. So we expect inflation to range between 17.34% to 19.16%. That's the annual average for year 2022. On our base case scenario, we expect inflation to be pegged at 18.26%. And some of the things that we've considered are the upside risks to inflation. This upside risk still remains elevated, one of which is the persistent conflict in food producing regions. Already coming into the year, we saw that inflation already peaked at 18.60%, which is a 5-year high. And we do not see this receding anytime soon in the year, especially when we consider infrastructural challenges in food producing regions, consider insecurity issues as well. And we've also considered, higher pressure on imported price index, the fact that the economy is largely reliant, on importation of crude, critical inputs, cooking oil, wheat, and even fertilizer, as well as hiking electricity tariffs, which would also impact, the core index. And we've also considered the high likelihood of the economy being awash with political spending ahead of the upcoming 2023 general election. As to the monetary policy, so far this year, we've seen that the monetary authorities have hiked rates consecutively in order to cope the soaring inflation figures. The first was in May, and then the second was in July to 14%. Going forward, especially feeding from our expectation of a higher inflation figure, we expect the monetary authorities to further hike rates in its upcoming meetings. for the rest of the year. On the fiscal authorities, what we've seen so far, especially from the data from the budget office, shows that our revenue came in at subpar levels, both oil and non-oil. However, our expenditure already closely trails the budgeted benchmark for the first 4 months of the year. And what we are seeing is we're already seeing a high fiscal deficit to GDP that already surpasses the 3% benchmark. Going forward, one of the things that we've considered is the low crude oil production volumes, and as such, the low oil revenue. So yes, we are aware that there are efforts on the government aspect to improve its tax generation efforts. We have the likes of new telecom tax, we have the tax on alcoholic beverage, and we have increased education tax. But then the challenge still remains: to what extent can these make up for the much needed revenue? So we do not expect the government to be able to generate as much revenue as needed. We've also considered the external sector, and I have the chart to my left speaking to foreign trade. Now, foreign trade was also significantly impacted by the rising crude oil prices, and as at the first quarter of the year, we saw that we recorded a trade surplus of 1.2 trillion naira. This is the highest in 10 quarters, 10 consecutive quarters. And this is largely due to the fact that we have high crude oil exports during the period, which surged significantly by 175.15% year-on-year. And we can attribute this to higher crude oil prices. But then we can see that despite the high oil prices, the accretion to external reserves still remains low. The chart on external reserves is just directly beneath it. So this is coming on the back of the high petroleum subsidy bill, as well as the low oil production volumes. And as such, on the high and low window, we can see that exchange rates of naira to dollar depreciated as at the second quarter of the year to 425.05 naira to the dollar, as against 416 naira to the dollar that was recorded in the first quarter of the year. So for foreign trade, our outlook is we still expect further rise in crude oil exports and crude oil export values, especially feeding from high crude oil prices. But then we are concerned about exchange rate volatility issues. We are also concerned that soaring inflation figures across the globe would sort of impact on importation negatively, and that would erode the trade surplus that we are seeing now. And on external reserves, we expect these to remain under pressure for the rest of the year. We are looking at low oil production volumes, and also we are considering the fact that we are looking at low oil production volumes, yes, but then we are also considering the fact that there are some interventions by CBN, to prop the non-oil exports, one of which is the R600 FX program that was recently established. So this would help to boost our, external reserve balance and provide some respite. On the exchange rate, for the exchange rate at the official window, our forecast is that exchange rate would range between 425.66 naira to the dollar to 515 naira to the dollar, with our base case scenario pegged at 438.66 dollar. And some of the things that we've considered are the high oil prices, that's despite the low production volume, and we are also considering the increased FX demand, especially ahead of the 2023 general election, as well as the accretion to external reserves. Okay, so that brings me to the end of my section on the presentation. Thank you.
Great. Thank you so much, Mosumola Adeoye. That was quite insightful, very descriptive, and a lot of information being passed across. I want to trust that our audience, our investors, distinguished ladies and gentlemen, I want to trust that you can hear us audibly, and this information is beginning to make sense. Okay, we'll move into the next segment of this presentation, and we'll be having Damilare Ojo, who'll be speaking to us on the markets, what the outlook for the markets has looked like for what the outlook of the markets generally would look like for the second half of the year. Damilare Ojo is a senior analyst, and he leads the Meristem investment research team, and he'll be speaking to us generally on what market segments are like generally. So Damilare, please, let's have you.
Okay, thank you very much, Omoife. Thank you everyone for joining us again. So I'll be speaking to the financial markets, both the equities market and the fixed income markets. And I mean, for each of those markets, I would also be looking at the global markets and then the domestic markets. So for domestic equities, excuse me. So to start with the global market, so what we've seen in the global market is equities market is that there's been a growing concern for recession, which Mosomola made mention of earlier. And due to the growing concerns, global equities have taken a beating largely. One is, on the one hand, we are seeing a lot of liquidity also being rolled back from the market, coming from what we had during the COVID-19 period. Also, we are having, a lot of technological tech stocks, which the traction around them is no longer so much compared to the high usage, high adoption of those of the underlying companies' products during the period of COVID-19. So that's, and the rising concern for recession, as well as the hiking rate, which as it is, makes fixed income markets a more viable alternative for investors, has made global equities market to be experiencing a bearish sentiment. And what we can see from this chart is that all major indices, global equities indices, recorded decline in H1 2022. Coming into the domestic equities market, our equities market is like the only outlier, topping its 14-year, having the highest performance in 14 years. And when we compare our returns, which is over 21%, to that of comparable, our peer African countries like Ghana, South Africa, Egypt, and Kenya, as we have on the chart here, we see that we are the only outlier recording a positive gain in H1 2022. And then the major drivers for this gain that we saw in the Nigerian equities market are the low fixed income yield, the strong sentiment on large cap stocks, because much of these gains is also driven by a lot of the large cap stocks that we have. We also have good corporate financial performance. Across sectors, we are seeing performance being very good, and investors are taking position, as well as funds for dividend. We know that performances, 2021 full year results were released around March, April, and that followed, following that was dividend period. So on for dividend was also one of the factors that drove the positive sentiment around the Nigerian equities market stocks. When we look at the sectoral performance, we'll see that 3 sectors recorded, gains, and the highest performing sector was the oil and gas sector, which recorded over 58% gain. And much of this was driven by, strong sentiment on Seplat and Total. And then the table next to that shows the major corporate actions that we had within the period. This year started with the listing of 18 billion units of Boa Foods shares, and then we had Dangsem during the second tranche of its share buyback program. We also had Seplat announcing the proposed acquisition of Mobile Producing Nigeria Unlimited, and then we had Access Bank transforming to an old company. Then Wema also completed its rights issue within the period. These are some of the corporate actions that drove sentiment in the equities market. And then looking at our expectations going into the second half of the year, much of the drivers of the returns in H1, the first half of the year, are also going to be, very much around with us in the second half of the year. And we have positive corporate earnings. And we note that the large cap stocks, I mentioned earlier that some of the, I think a significant portion of the gains that we recorded in the first half of the year was driven by buying interest into large cap stocks. And we are, from our own perspective, some of these large cap stocks have already been overbought, and there might be sell-offs on some of them in the second half. And as a matter of fact, so far this week only, we are already seeing that sell-off on one of them. So we also note that fixed income yield, the dynamics in the fixed income markets would also shape what happens in the equities market, because these are the two largest and regulated markets in the Nigerian financial market. And then the hunt for dividend, there will be interim dividend on some tickers that can also drive buying interest. And lastly, we note that foreign participation has been very low in our equities market. So we don't think that, although we know that due to the heightened risks as we move towards the election period, the heightened risk might cause some sell-offs, rotation of funds from equities to the less risky fixed income markets. But we don't see, that to be, we don't expect that to be driven much by foreign investors, because we don't even have a lot of participation. When we look at the statistics, there's not much participation in our domestic equities market from foreign investors. And overall, for the second half of the year and for 2022 full year, we are expecting that the equities market is going to return 25.08%. That's for the whole year, from the over 21% that it's already had in the first half of the year. And considering all of this, we looked at we are presenting our fixed income, our equity strategy on this slide. And from our strategy, we came up with our strategic portfolio for the second half of the year. And it is worth noting that in the first half of the year, our recommended strategic portfolio returned over 13%, which is higher than its benchmark. That's the NGX 30. So we also came up with this strategic portfolio for the second half of the year, and we considered in coming up with this strategic portfolio, we took both a top-down and a bottom-up approach. That's, we considered, the macroeconomy, we considered the sectoral performance, the outlook for each sector, and we also looked at each commodity, each ticker, each company's underlying fundamentals, and coming up with this strategic portfolio. And compared with our H1 strategic portfolio, from what we have now in the second half, the tickers that are being removed from our strategic portfolio are custodian, Dank Sugar, and NEM. And I already mentioned that we consider their sectoral outlook, as well as the company's underlying performance. That's the outlook for each ticker as well. And from this exit, we also have some new tickers that we are adding to the strategic portfolio, which are MB, Vitaform, and WAPO. And altogether, our strategic portfolio is expected to return 47.90% in the year. Moving on to the fixed income market, looking at the global fixed income market first, what we've seen is yield trailing policy rates. My colleague earlier mentioned how monetary policy authorities are now becoming a lot more aggressive in terms of hiking rates, their policy rates, in order primarily to fight inflation, rising inflation. So yield has also been increasing in the global market, closely trailing that the hike in policy rates across board. Some of the major factors that we attribute this bearish sentiment to are inflation expectations. And there's this expectation that inflation is still going to rise, because some of the underlying causes of inflation are still very much around. And, these charts just show that there's been a decline in the indices that track the prices. We know that there's an inverse relationship between price of fixed income instruments and the yield. So as yields are increasing, prices are declining, which is what the charts really shows. And for emerging markets, the second chart, we've seen a bit of volatility across board, but then generally, there's still also that bit of, sell-offs in the fixed income. Buying interest rather into the fixed income market as yield is increasing across board. Now, moving into the Nigerian domestic fixed income markets, liquidity has largely been the driving force, the driving factor. And more recently, we are also seeing a change in monetary policy stance, which is also now shaping what we are experiencing in our fixed income market. So, talking to the bit of liquidity, the system liquidity shaped caused a sort of divergence between what we had in Q1 in the first quarter of the year and in the second quarter of the year. In the first quarter of the year, there was high liquidity in the system, and that was majorly driven by the maturity of an FGM bond, which was over 600 billion naira. So what we saw then in the first quarter of the year was a downtrend in yield. But coming to the second quarter of the year, the system liquidity reduced, and then we are also now experiencing aggressiveness of our monetary policy authority increasing rates. So combining these two factors, yield has been increasing in the second quarter of the year. So looking at it holistically now for H1, that's the first half together, what we are currently, what the market closed at was increase in yield compared to where we were at the end of last year. The corporate debt markets also saw a bit of activities at the beginning of the year due to low yield, but coming to the second quarter of the year, there was reduced activity as yield began to pick up. Then the FGN also, that's the federal government, tapped into the Eurobond market earlier this year, that's mid-March, to raise 1.25 billion USD. And then Eurobond yield was still relatively low, but due to the increased aggressiveness of monetary policy authorities across advanced markets, Eurobond yield has also been, is also increasing now. It's also high. So that has informed the federal government's decision to shelve the plan to raise an additional 950 million USD in the Eurobond market. And moving to our outlook, first is that we note that there's going to be, there's higher political risk in the second quarter, in the second half of the year as we further move closer to the election period. And we think because of that, investors might favor the, less risky. We know that fixed income market is less risky compared to equities. So investors might, favor that market more to sort of, as a sort of shield for their capital, for their investments. For Eurobonds, we are not expecting that the federal government is going to raise as much anymore from that market this year due to the high yield, in the Eurobond space. And that means that government is going to have to raise the remaining deficits, that's the deficit from the 2022 budget. It's going to have to raise that in the domestic market. What that then means is that we are going to be having high, amount of money going to be raised in the primary market auction compared to low liquidity that we have in the market. So combining, these factors means we are very much likely to see, higher yields in the second half of the year. And when you also look at expectations in the market is also further expecting that the monetary policy authority is going to further hike rate because the tone is now very much aggressive. It's speaking to aggressiveness in raising rates. So, when we look at all of these things, they just all point to the fact that yield is very much likely to increase in the fixed income market. And because of that, putting all of these factors into consideration, we come up with our fixed income strategy. For us, we think that it is very important to manage duration. So because of that, we've split our recommendation into two. One, looking at what should those holding fixed income. We know that different investors hold fixed income instruments for different reasons. Some investors hold it for trading portfolio, for trading purposes. Some, because of the nature of their business, particularly pension fund administrators, PFAs, they have to hold, match the maturity of assets with the maturity of their liability, and the liability for them is long-term in nature. But for investors who are holding fixed income instruments for trading purposes, we are recommending a short position, that is to operate more in the in the short end of the curve and take short position. Short position would mean that you are selling what you don't have, essentially. That is with the expectation that yield is going to increase and price is going to decline due to the inverse relationship between price and yield, which I referred to earlier as well. Then, putting into consideration PFAs or other investors that have a long-term horizon, we are recommending a short position combined with operating in purchases of long-end instruments, long maturity instruments in the primary market, so that at the end of the day, by the time you do a weighted maturity, you will still be able to match the long maturity of your assets with that of your liabilities. And then speaking briefly to alternative investments, which would be the last now I'll speak to for now. One, cryptocurrencies. There've been a lot of noise around cryptocurrencies. I'm sure a lot of people that maybe don't even know about these products before now, they now know about cryptocurrencies this year because of the nosedive in the value of cryptocurrencies this year. So there's that bearish sentiment around cryptocurrency with Bitcoin. Bitcoin is the leading cryptocurrency by market cap. It's lost over 50% in the first half of the year. And Ethereum, which follows it, lost, 272%. That's very, very huge. And the reasons for this, for us, we think that the lower liquidity, as well as the aggressiveness of central banks in raising rates and in also tackling, trying to minimize the system's exposure, that each central bank is trying to limit how much their own system is exposed to the volatility in the crypto market. So those are the things that we attribute the decline, the bearish sentiment in the cryptos market too. And the outlook, is still that for us, we still maintain that investors should be cautionary about their, operations or their activities in that crypto market, for particularly for Nigeria, where these assets remains a lot, unregulated. And for the real estate market, we've seen that on the global scene, there's negative sentiment, but, in Nigeria, we saw that there's that consistent improvement in the real estate GDP, and investors are also very much positive. And our outlook is also that real estate is going to perform well, because one is, we know real estate is an edge against inflation. And we've seen that, really play out in the market. Then for commodities, we expect that the prices of commodities are still going to be, very much elevated due to the fact that there's still supply shortages around commodities. So we think that that's also something viable for investors to plug into. Thank you very much.
Great. Thank you, Damilare. Lots of insights, lots of information. Okay, so for our investors and audience, we want to urge you, kindly make use of the question and answers tab. Type in your questions. When we get to the segment for questions and answers, we assure you that the questions will be asked and answers will be provided. Peradventure, you may want to ask your questions verbally. You can make use of the raise hand tab. We would acknowledge, unmute you, and then you'll be allowed to ask your questions verbally. We're not done. I think the conversation is getting more interesting. So we'll be going next into specific sector analysis, looking at some sectors within the economy. We'll review and give our outlook on the sectors for how we see them performing for the second half of the year. And Damilare, please stand by. We'll be moving next into the banking sector, the financial services sector, And Damilare would give us an overview on what each one has looked like and what we should be looking out for the second half of the year. Yeah, Damilare, you can please go ahead.
Thank you very much, Omoife. So I'll be quickly talking about, our outlook for this. A quick review of events in the first half of the year in the banking sector. And this table just, highlights the key events. One, we saw after the transformation of Access Bank to Access Corp, that's following their transformation to an old cost structure. The bank, that's the group now, announced the acquisition of Sidian Bank in Kenya, and they already had a footprint before in Kenya, and this is further to the bank's strategic long-term investment play to say they want to move into high growth potential African countries. And for us, we think that this is something that is very key for the sector. One, the Nigerian banking sector is very much competitive, and we are seeing a lot of competition, even from some fintechs across different nodes of the value chain in that sector. So for us, we think that what is going to drive value for companies in this sector are going to be two major things. One is that you have to find a way as a bank to shield yourself from the volatility in the fixed income markets. That is, play more with, drive more value with non-interest income. Or, the second thing is to move into high growth potential African countries, which is what Access Bank is doing. So right now, Access Bank now has almost 1% of market share in Kenya. That's still a bit low, but when we look at it from the perspective that they are also moving into other African countries, we see that this is something that is likely to drive value for them in the long run. And within the same period, Access Bank also acquired First Pension Guarantee Limited, and this would also, is further to the strategic decision to divest, to bring in more financial services offering in order to have more non-interest income. For GTCO, there was that, acquisition of Investment One Pensions Manager as well as Investment One Funds Management Limited. And we think these things are going to, these particular businesses are going to add to the group's non-interest income. Within the same period, we saw the acquisition of over 89% shares of UBN by Titan Trust Bank. Titan Trust Bank is not a listed bank anyway. It's not a listed bank. So we saw that acquisition within the period, and we note that this acquisition is going to just sort of match the Titan Bank. Titan Bank is still relatively young as a commercial bank in Nigeria. So this acquisition is going to just sort of help the bank to consolidate on the existing Union Bank's technology and match that with that of the relatively younger Titan Trust Bank to have a sort of more formidable banking institution. Then lastly, FBNH also announced the acquisition of Access Pension Custodian Limited, and we note that this is likely to also add to the bank's, to the group's gross earnings through non-interest income. And then the outlook for the sector this year, what we know is that the bulk of the bank's gross earnings right now is still sourced from interest income, and the rates that banks charge on their loans is anchored on the monetary policy rates. So right now, as we are seeing the monetary policy rates being hiked by the Monetary Policy Committee in Nigeria, it is very much likely that interest rates is also going to be reviewed, going to be repriced. That's loans are going to be repriced. At least maybe new loans that are going to be created within a period are going to be repriced, priced to reflect the hike in monetary policy rates. That, coupled with the expansion of loan books by banks, is means positive for the for Nigerian banks. And In the same vein, the interest expense, the rate on savings deposits, for instance, is also pegged, to the monetary policy rate. So as the MPR is also being increased, we're also likely to see increase in the interest expense. But we don't expect the increase in interest expense to be as much, to have as much impact as the increase in interest income. So altogether, we expect that the net, income, looking at interest income and interest expense, net interest income is going to, is going to increase across board this year. And what we also note that might happen this year might be that there might be earnings retention and some capital market activities to meet up with the new capital adequacy requirements. If you recall, towards the end of last year, the CBN introduced the new, the Basel III requirements, which is adapted for Nigeria's peculiarities in any case. So we're expecting that the move towards that, full adoption of Basel III is going to mean that banks would have to retain more of their earnings in order to meet up with the new capital adequacy requirement, because it is more stringent than what we had under the Basel II arrangement. Then across, the major banking metrics, including the non-performing loans and majorly the non-performing loans and liquidity ratio, we're expecting that those metrics are going to be stable throughout the year. And the table to the right just shows our top picks and the drivers. Our top picks for us in Meristem, we cover 13 listed commercial banks in Nigeria. And out of those 13, we've picked these 6 as our top picks within the sector. And, we have the drivers to the right of the table. For Access Corp, we think that's Access Bank now, as we know it's, but has transformed to an old structure. So the ticker is now Access Corp. The drivers that we have highlighted are expansion to high growth potential African countries. Like I mentioned, that of Kenya. They also have footprints now in Mozambique and, in other countries like that, which is also driving customer base higher. That is going to be their value driver. For Fidelity Bank, they are big on SME lending, and that is one major thing that they are using to drive transaction through digital channels. For GTCO, the operationalization of Abari Pay is going to be a major value driver, because what GTCO, their own strategy is to sort of create an ecosystem where, you as their client, as their customer, you can do almost everything within that ecosystem. We know that GTCO is into fashion, they're into food, into lifestyle. So further to that, creation of an ecosystem where, that enables their customers to be able to do everything that they need. They also got their approval in principle from the CBN to have this digital payments, digital payment subsidiary, which they call Abari Pay. So we think that is going to be a key value driver for them. And then the acquisition of the pension funds and pension and fund management businesses that I referred to earlier, to drive non-interest income. Then for Stanbic, we note that for them, the value driver is going to be their strong foothold in the wealth management business, as well as their digital banking drive. And for UBA, they also have Pan-African business. Recall I said earlier that one key driver for Nigerian banks, for us as our outlook, is that it is key for them to move away from just Nigeria, right? Those who are going to win in the long term are those who have, they have been able to either shield themselves from the volatility in the fixed income markets, or those that have been able to, improve their foothold in other high growth potential African countries. So this is something that UBA, has as a growth, as a growth driver, as well as their own digital banking as well. Therefore, for Zenith Bank, what we are seeing as a positive for them is the dominance in the corporate and their move into, into the retail space as well. They are very much in the retail space already now, which is a more recent initiative that they've taken in order to also earn more income. So that is our topics for the banking sector.
Great, great. Thank you, Damilare. Outstanding insights, strong recommendations, great outlook. Distinguished audience, it's not over yet. Kindly make use of the questions and answers tab. I'm sure there are a lot of questions that have been put together. These questions can be dropped up using the question and answers tab. Like I said, it's not over yet. I'd like to call on Juliana Ogunkoya, who will provide us some overview and insight on the consumer sector. So Juliana, let's have you.
Thank you, Tiger. Good morning, everyone, and welcome. I welcome you to our Outlook. So I'll be taking the consumer goods sector. So coming into 2022, our expectation for the consumer goods sector was broadly positive. And true to our expectation, most players delivered impressive performance despite the macroeconomic headwinds confronting the operating environment. When we look at the food and beverage sector, the food and beverage sector expanded by 9% in Q1 2021 relative to 7% in Q1 2021. And this was mainly because consumers are prioritizing the food and essential products that constitute this consumer good baskets. And other factors that the consumer good players have imbibed to improve top line also includes price increases and backward integration, capacity expansion, and several other techniques. So we can see the flour millers also introduced a new product, which is the brown sugar, to increase their portfolio, their product portfolio. USCN deployed additional spring water capacity, and they're also looking into also increasing their QBR, their quick service restaurant businesses, and also their agri-feed business. And also NB recently deployed an expansion capacity through a new project in Ama Brewery Industries at Benin City. And so with these several expansion initiatives, the consumer goods sector players are looking to increase their top line to cushion the effect of the several macroeconomic headwinds affecting the sector. We also can rule out the fact that CBN has introduced several Anchors Brewers program. For example, recently the CBN solidified its wheat production objective through investment in new seedlings and plans to increase wet season to improve wheat cultivation under its Anchors Brewers program. And also, Dank Sugar expanded its capacity from about 3,800 to 6,000 tons of cane per day in processing its sugar cane from newly developed farms. Also, the African Development Bank introduced an heat-resistant wheat seedling through research funding. All of these factors are to improve the level of wheat cultivation, and we know what we have locally is not sufficient to meet the current demand of most of these consumer good players. Even for sugar, we import about 98% of what we consume in the domestic market. So with all of these factors, most of the consumer good players are looking into backward integration strategies to see how they can improve with what we have domestically and to minimize importation. But for now, this is what they still have to work with. And looking at the, in terms of costs, it's glaring that most of these consumer good players are still having challenges with logistics, spiraling inflationary pressures, foreign exchange inaccessibility, high energy costs, among several economic headwinds. And with the recent geopolitical tension, which has further impacted the prices of wheat, maize, sugar, we're seeing that these consumer good players would still have to deal with high cost of production. And like I mentioned earlier, majority of the raw materials that these consumer good players make use of locally are imported from most of the global prices is what determine the dynamics of the movement of most of these raw materials. So we should still expect that the consumer good players will still have to deal with rising cost of raw materials in the near term. And also, looking at what we expect for 2022 for the rest of the year, although most consumers still prioritize most of this essential item, people can do without eating, and also some of this products the consumer good players produces. So we should expect that domestic consumers still continue to demand for most of these products, and this should be able to support their revenue. And also with the implementation of several growth initiatives, we should expect all of this to support the top line, most of these players' top line in the near term. When I mean growth initiative, I'm talking about some of this backward integration strategies implemented by the flour millers, and also expansion initiative by companies like USCN and the likes. And also given that this 2023 is going to be an election year, we are seeing a lot of electoral campaign related spending, which we expect to support the brewers this year. So, however, with the high reliance on importation of raw materials like barley, wheat, sugar, we should still expect high cost of production for most of the consumer good players. And so for this reason, we do not foresee considerable moderation in the cost of production for most of these companies. And so based on our valuation metrics, our top picks of all the consumer goods companies we're covering, some of our top picks include the flour millers, USCN, and Nigerian breweries. For the flour millers, we've seen they have been doing a lot of product innovation, increasing their product portfolio by introducing a new brown sugar product. And we're also seeing backward integration strategy, collaborating with other research institutes, like working with African Development Bank. And also there was a recent partnership with the Lake Chad Research Institute to increase capacity building activities for wheat production in the domestic market. And also for USCN, like I mentioned earlier, they're doing a lot of expansion initiative, trying to expand their spring water capacity, trying to expand their quick service restaurants, and also their animal feed business. So we expect this to support their top line. And for Nigerian breweries, being the king of the beer market, we expect that their capacity building should support top line. And based on their Q1 results, they performed very impressively. We expect them to sustain that momentum. We expect this electoral campaign-driven spending to also support domestic demand even further than it is now. So we are very positive about the selected companies. Like I said, we do not rule out the impact of the rising cost of production, which might affect the quality of earnings for these companies. But for their top line, we're very optimistic, considering the various initiatives that these several companies have implemented to support their top line. So that brings me to the end of the consumer good outlook. Thank you.
Yes. All right. Thank you, Juliana. Thank you. Interesting insights there. Interesting outlook. In case you're just joining us, investors, this is the Meristem outlook for the second half of 2022. And we've titled it Unearthing Value in an Unending Crisis. I'd just like you to look to your chat box. Look on the chat box. There's a form that we've dropped in there. Please, I want to admonish, kindly fill out those forms just in case you require to speak to an advisor. Please oblige us and fill the form which has been posted on our chats. The conversation is still very much ongoing. We want to take a peep into a very interesting sector in our economy, which is a boon for the economy, and that's the energy sector. And so Kelechi will be taking us through the overview and our outlook within that sector for the second half of the year. Kelechi, please, let's have you. Thank you.
Thank you very much, Omoife. Welcome again to our 2022 half-year outlook. So diving into the events that happened in the oil and gas sector in the first half of the year. So like my colleague mentioned, the oil sector GDP declined significantly this year. And we saw that contribution to the oil sector, which was previously approximately 10%, has dropped to about 6% contribution to the GDP. And one of those factors that have led to this decline is due to oil theft, and also, we have aging infrastructure which require incessant maintenance, and also low investment into the sector. We saw that in the first half of the year, production from the country declined by 5.13% year on year. In June, we saw production hit its lowest, and Nigeria was able to produce oil, about 1.2 million barrels per day. Now, this is the lowest level of production that the country has had in decades. And like I said, it's majorly due to the oil thefts that we're experiencing. We've seen that some pipelines that evacuate oil from this producing site to the terminals, for example, the Trans-Niger pipeline, which has capacity to transport oil about 280,000 barrels per day, has been shut down. And one of these factors is due to the oil thefts and vandalism that we were experiencing across the lines. And we feel that the reason for this high theft is due to, we're seeing oil prices skyrocket. Now, the nature of the oil and gas value chain, or supply chain rather, is a way whereby it's easy for crude, gotten illegally to enter into to be sold in the legal market. And then because of this, we've seen that the high rate of vandalism, oil theft, has actually skyrocketed due to the increase in oil prices that we are seeing presently. And based on reports we've seen from NMPC, we've seen that even we've had no allocation to FAC since the start of the year. And also we've seen that production losses has averaged about 9.46 million barrels in March. And if you put that in dollar terms, given that oil prices are above $100 per barrel, that translates to the country has lost about $1 billion, in revenue that we should have earned. So then, it just kind of highlights the significant issue that we're experiencing with the high rate of vandalism across our export lines. Moving on, we've seen series of acquisition, separate acquisition of the Exxon, of the Mobile Producing Nigeria Unlimited. We've seen that so many IOCs, have begun to plan divestment of most of their onshore and shallow waters asset. Total, for example, early in the year announced a planned divestment of 10% stake of their SPDC JV asset. Even Shell in itself also last year mentioned planned divestment of all their onshore and shallow waters assets. And what that means is that, shallow and onshore assets are basically assets that are located, along the land, and where is more successful. So there's more chances of oil theft to occur in those kind of assets. So because of that, we see the likes of ExxonMobil, Shell, Total, planned divestment of this asset. But good news is that many of these indigenous companies have started to pick up this asset. Like I said, we've seen Seplat, planning a 100% acquisition of the Mobile Producing Nigeria Unlimited. But another key issue is that we've seen actually low investment into the sector. Based on reports from the MBS, we saw that foreign investment into the oil and gas sector has declined to $0.6 million. And that's the lowest we've seen in Q1. And we're coming from a level of about $700 million investment into the oil and gas sector in 2016. And even last year, we had investment of about $100 million. But then we've seen that value decline to 0.6. So it only shows that there's a lot to be done, really, in terms of reviving the sector. But then we see that the PIA, we now have the new PIA that gives more clarity to the sector. And many of these IOCs are going into deep water exploration. So we've seen the likes of Total, we've seen the likes of Shell. In fact, all the IOCs have one or two deep water projects that they are looking at. And that paints a positive outlook to the sector, because in each of these assets, we are not expecting anything less than production volumes less than 150,000 barrels per day. So going forward into the year, we are still we still have let's say a dim outlook of the sector, unless there's a concrete effort to address the issue of oil theft. We still see production reaching 1.6 million barrels per day. Our quota is about 1.8. I mean, by August, we will see OPEC Plus phase out the quota-induced reduction that occurred in 2020 in April. So we're seeing that phase out by August, but then Nigeria still lags behind in terms of production as against its quota allotted to the country. So going on to the outlook for the energy sector, our outlook is actually positive. Would I say moderate, really? And this is because of the increase in oil prices that we're seeing. I mean, oil prices has touched $100 per barrel since March, and this is basically due to the Russia-Ukraine crisis that has kept prices elevated. There's no, will I say, positive outlook that shows that the crisis is going to tone down. I mean, recently we heard that some countries are putting a cap on the Russia oil, and then Russia is saying that they are not going to supply to countries that put a cap on their prices. So that has really kept oil prices elevated above $100 per barrel. So, and it's a positive win for companies like Seplat. Seplat, we just released their figures this morning, and we're seeing more than 100% increase in their bottom line. So the increase in the oil price is actually impacting the company positively. And by that, we've actually reviewed our target price to 1,358. We also see that, and because of the restraint in access to dollars, some investors are kind of using the ticker is listed in the London Stock Exchange, likewise in the Nigerian Stock Exchange. So, investors are using that as a capital repatriation, but then, which has pushed the prices upwards. But fundamentally speaking, the stock is still a good hold at this point. So anyone who have the stock can equally hold the stock because it poses good upside in the future, especially if we see prices staying elevated. So for the downstream sector, we've seen that the increase in oil price has actually affected prices of liquid fuels. We've seen kerosene, jet fuel increase more than 100%. The reason why we've seen PMS, that's the premium motor spirit, or the petrol, like we know it as, stay within 168. But recently we've seen that prices have been reviewed to 170. So, we still have subsidy. The government still pays subsidy on that commodity because of the increased usage of that commodity by Nigerians. But then when you look at other segments, that's the diesel, kerosene, and even jet fuel, we've seen prices increase more than 100%. And this has really supported top line for most of our downstream companies. For example, Total recorded an improvement in their top line and bottom line. And one unique thing, we recommended Total as one of our stock picks because Total has a way of, has been able to initiate a good corporate strategy whereby we've seen retail segments contribute 50%, likewise corporate. So Total has been able to achieve a 50-50 split in their retail sales and also their corporate sales. And also we're looking at their lubricant business too. The increase in oil price has also impacted the prices of lubricants. And we've seen revenue from that segment increase by more than double. We've seen revenue double in that segment. So this has really impacted their bottom line. And we even saw for 2021, they declared an increase in their dividend payment. So based on these fundamentals, we've seen it as a good buy for investors. And we're putting our target price at 341 naira per share. So similar to Cornell too. Cornell is a company that has maintained consistent dividend payouts. Come rain, come sun, come snow. At every level they have maintained consistent dividend payments of nothing less than 1 naira. And even last year, 2021, they declared dividend of 2 naira 50 kobo. And if you look at the dividend yield on that stock, it gives you approximately 10% dividend yield. But we want to also point out that, well, in terms of the top line, corn oil has not been performing really well. And we could attribute this to, we've seen the fuel scarcity really impact most of these downstream companies. And what advantage that Total has really is the fact that it's an integrated company and they've been able to take, leverage on their parent company. But for other companies like indigenous companies like corn oil, the struggle is really tough. But then we want to benchmark that, historical outlook whereby, like I said, come rain, come shine, corn oil will still maintain their dividend payment. So we see that a good buy for investors that are looking to earn very good dividend payments for the year. So on this note, I will wrap up the outlook on the energy sector, and I will hand over to Omoife. Thank you.
Great. Thank you, Kelechi. Interesting perspective, I must say. Thank you for that. Thank you so much. Okay, just for our audiences, we like to say on the chat, you can look to the chat. We've provided the Outlook reports for you. You can click on the link to download the report, just in case you want to go through it extensively in your quiet time. We're not done yet. The final sector, which we would review before we delve into the questions and answers, and that's the telecommunication sector. No other person than our own Abdulateef Grillo will be giving us an overview and the outlook for that sector for the second half of the year. Abdulateef, the floor is yours. Thank you.
Good morning, everyone. I'll be taking us through the review of the telecommunication sector during the first half of the year and our outlook for the sector going forward. So the telecommunication sector has been one of the best performing sectors in the Nigerian economy. And during the first quarter of the year, the telecommunication sector expanded by 14.5% year on year, which is almost double what it did during the same period of last year. The growth being witnessed in the telecommunication sector is attributable to a number of factors, including the increased subscriber base that we're currently seeing in the sector, which alludes to the fact that the services of the telecommunication network providers are actually being consumed, and the rate at which are being consumed is increasing. And also we are seeing an increase in the average revenue per user in the sector, mostly coming from data services. So a trend that we saw linger in the sector during the first half of the year was actually the change in dynamics of revenue of telecommunication network services providers. So their voice revenue services is actually the bulk of their total revenue, contributes the most to the total revenue, but we're actually seeing other segments of their operations actually contribute more to the total revenue, and this is reducing the contribution of voice revenue to total revenue. For context, during the first quarter of the year, voice revenue made up about 52% of the average revenue of listed players in the sector, and this is down from about almost 65% 3 years ago. So we are seeing a surge in the growth rate of data and fintech revenue services specifically, and this is actually reducing the contribution of voice to total revenue services. Even though voice revenue is also growing, it's growing at a slower pace while compared to data and fintech services. So a notable event during the first half of the year that happened in the telecommunication sector was the restriction placed by the NCC, the Nigerian Communications Commission, on outgoing calls from SIM cards that were yet to be linked to national identity numbers. We recall that towards the end of 2020, in December 2020 specifically, the NCC, which is the regulator of the telecommunication sector, initiated a process whereby they asked all mobile network operators to link the SIM cards to collect the national identity number details of their subscribers and link that to their KYC of the subscribers. And this was just in a bid to perform a comprehensive SIM card audit for all registered subscribers in the country. So the initial deadline set for that was the end of that year, 2020, but we saw the deadline being shifted a couple of times, about 5 times. So the most recent deadline, which actually was the 31st of March. And the reason for that was due to the prevailing security issues in the country, which put pressure on the NCC to actually bar outgoing calls from the SIM cards that were yet to be linked. So as at the end of April, for the listed players in the sector, they already collected NIN details for more than 70% of their subscriber base. And this subscriber base actually represents about 90% of the revenue generated for these mobile network operators. So we don't actually expect this action to have any significant impact on revenue for mobile network operators. If it's going to have an impact on revenue, mostly for the second quarter of the year, because the immediate response to the ban on outgoing calls was a surge in the number of SIM cards that were linked to the NIN. So a lot of people actually rushed to go and link their SIM cards to their NIN. So, and also the only service that has been impacted by the ban was outgoing calls. So even for the SIMs that were bad, they could still receive calls, they could use SMS and data services. So we expect the impact of that to be minimal on the revenue of players in the sector. So also on the fintech front, fintech is something that mobile network operators have been paying a lot of attention to lately, and the two biggest players in the sector actually, they got the final approval to operate payment service banks in the country. So that makes it what that makes it is that all four players in the telecommunication sector now have approval to operate payment service banks in the country, and this is equal to the CBN's drive to explore the fintech-led mobile money service in order to drive their financial inclusion motive. So we have seen this fintech-led model actually work very well for other sub-Saharan African countries, particularly we've seen what played out with M-Pesa in Kenya and other countries too. So this is something that the CBN is trying to explore, and also the mobile network operators are trying to tap into that. So what the approval of the payment service bank license does for the mobile network operators is that it gives them the right to receive funds from their subscriber base, keep wallets for the subscriber base, issue debit cards, and even invest the funds they collect from their subscriber base in treasury instruments. So we expect this to mean well for their fintech operations, increase volume, and subsequently increase the revenue generated from fintech operations, and overall make fintech a bigger part of their overall operations. So for our expectation for the telecommunication sector is quite positive, and this is drawn from the subscriber base increase, a number of factors really, and some of those factors are the increase in subscriber base we are witnessing in the sector. We expect that to persist. Subscriber base presently is at about 205 million, and we see that even increasing further, because if you look at the tele density, we think that can go up higher. And also we expect the data revenue as being one of the best performing segments of mobile network operators in recent time, and we don't see a change to that anytime soon. We expect data traffic to increase. We have seen the aggressive 4G rollout by players in the sector, planned 5G launch also by some players in the sector later this year. So we expect all of this to mean a better data experience and more data consumption by the subscriber base. So we expect this to also lead to increased data revenue for players in the sector, and also increase data average revenue per user. So we see data and fintech particularly becoming a bigger part of their operations, contributing more to their revenue. And also for fintech transactions, we expect higher transactions for fintech services now that they are able to operate with payment service banking license. So for both of the listed players in the sector, we are very positive about their performance going forward. We expect them to do very well. But based on our valuation of the players in the sector, our top stock pick from that sector right now will be MTN, based on our valuation and our target prices at the end of the year. Like I mentioned earlier, data and fintech are expected to be the major drivers of growth going forward. So thank you very much. That'll be the end of my presentation.
Thank you so much, Abdulateef. Thank you. That was beautiful. Great insights, great perspective. Once again, we want to say thank you, our audience. Thank you, investors. This is our second half outlook presentation for 2022, which we have titled Unearthing Value in an Unending Crisis. I want to believe that the conversation has been pretty interesting. A lot of information, great guidance, direction that has been laid out for us as investors for the second half. We'll be going into the last segment of this presentation, and that has to do with questions and answers. Quite a number of questions on the question and answer tab. Just in case you have more questions, please make use of the question and answer tab to drop your questions. And you probably want to ask questions verbally. Just kindly use the raise hand tab. We would acknowledge, unmute you, and you'll be able to ask your questions. Okay. I'd like to take the first question here from Tim Chang. So Tim Chang is saying, thank you for the presentation, Mosumola, precisely. Just a bit curious about your expectations on further increases in the MPR. Tim Chang is saying, in your view, and based on prevailing and expected economic realities, should the MPR be higher? If you think so, why? If you do not think so, why not? Mosumola, I don't know if you heard me clearly.
Yes, I did. I heard you clearly. Thank you. Okay, so to address the question, let me start with the first question concerning our expectations for a hike in rate, further hike in rate for the rest of the year. One thing that we considered was the body language of the Monetary Policy Committee, as at the previous meetings when they decided to hike rates. And some of the reasons that they alluded to was, one, the soaring inflation figures. Now we are seeing inflation figures almost close to the past record high at 18.60% as against 18.72% in 2017. And in addition is also the fact that there's this risk of capital flow reversals, especially now that several countries across the globe and in advanced economies are beginning to hike rates aggressively, and that poses that risk of capital flow reversal. And then to answer the second question, do we think in our own perspective that further hike in rates by the MPC is the right decision to make at this point in time? I would like to say that the sterility, or should I say the neutrality of further hikes in rates, as we've seen in the past on inflation, is largely due to the macroeconomic vulnerabilities in the domestic space. Yes, there's the aspect of a monetary issue concerning inflation, that's growth in the money supply. However, we will see that the inflation that we're experiencing in Nigeria is largely structural. So it's more of the infrastructural deficiencies that we are having, insecurity challenges that we are having in food producing regions. And we'll see that according to the National Bureau of Statistics, the average Nigerian household spends more than 80% of disposable income on food. So which then means that unless these issues are being addressed, especially for the food index, it would not really, I mean, the hike in rates will not really impact so much on addressing inflation. So I think that it's time to make decisive moves concerning addressing these infrastructural challenges, and then we can begin to see the impact of hikes in rates on inflation figures. Thank you.
Great, thank you, Mosumola. So in a nutshell, we might not necessarily see a positive impact irrespective of these rate hikes. Okay, this is a follow-up question for you, Mosumola, and Victor is asking this question also, which I quite agree with. It says, given your view on inflation and expectations on further rate hikes, by how much do you expect the MPC to further raise rates this year? Yes. Where do you see rates? What's the highest do we see rates by the end of the year?
Okay, so in addressing that, I would say that so far in the past 16 years, the highest that MPR has attained is 14%, which is where we are right now. And this is since when CBN started tracking data on MPR. So I would say that now that inflation figures are beginning to rise, and most likely for the rest of the year might even hit new record highs, it's quite dicey to call the rate at which MPR will be pegged at, but we know that there are further possibilities that there will be hike in rates going forward. So I think it would largely depend on the extent to which we see inflation soar for the rest of the year.
Great, thank you. Difficult to call, right? But definitely we expect further hikes if possible. And the CBN governor obviously has alluded to that if inflation continues to rise, definitely they're likely to continue to hike rates. But to what extent, we cannot call. All right, thank you, Musumola. Thank you. I have this question here from Salisu. Yes. It says, good morning. Thank you for the wonderful presentation. I think I'd like to address this to Damilare. It says, good morning. Thank you for the wonderful presentation. I'm sure this question is more of strategy. It says, please, how has inflation or how can inflation affect my portfolio indirectly? And what measures should I take to maintain my position? I think this, you could just give a generalized response, obviously looks like.
Okay, thank you very much. Thank you to our esteemed client who asked that question. So one, I would say, the question starts with how does inflation affect the value of the portfolio? Directly, inflation affects the value of money and whatever amount of money that you have in your portfolio. So for instance, if you had 1 million naira in your portfolio at the beginning of the year, right now, I mean, the level of the quantity of goods and services, if you liquidate that portfolio today, the level of goods and the amount of goods and services that you can use that 1 million naira to purchase is not the same thing. I mean, that you can use it to purchase today, you'll be getting a lower value for that same amount of money today. So that is one direct way. So it affects, I mean, inflation reduces the real value of your portfolio. Again, if you are looking at the returns on your portfolio so far, we want to distinguish between nominal returns and real returns. That's another way by which inflation affects the value or the returns on your portfolio. So you might be looking at, okay, what is the return so far? Then when you adjust it for inflation, you would be having what the real rate of return is on your portfolio. Now, the other part of the question is now, how can one shield, one's portfolio from the impact of inflation? So in Nigeria, I would say that the depth of our financial markets really makes it a bit of an Herculean task to want to shield portfolio from the impact of inflation. I mean, in other advanced climes, you have things like inflation-linked bonds that you can use to shield your portfolio from the impact of inflation, but we don't have that in Nigeria. So, but I think the only viable alternative that we have in Nigeria that can shield one's portfolio from inflation, from the impact of inflation, is real estate. Real estate, and when I was talking about alternative investment and I was referring to real estate, I mentioned that one thing that has been agreed on in the investment, in the financial, literacy, is that, or literature rather, is that real estate is an inflation hedge. It provides that inflation hedge. So, but one of the peculiarities of real estate now is that it's, depending on what you want to do, it would typically involve a long-term horizon and a huge capital to start that. So I wouldn't know, how much that would be, possible for an investor to go into, unless you have a long-term horizon and you have huge capital to start that. But the alternative that you also have to that is to invest in REITs. There are listed REITs on the market. There are about 3 of them that are listed, and that is one thing that you can use to, I think that you can use to shield your portfolio, away from the traditional assets of equities and fixed income. So REITs provide that opportunity given our current realities in Nigeria. Thank you.
All right, thank you. Thank you, Damilare. Damilare, I'd like you to hold on. I think quite a number of questions for you, because I know you give us the outlook and review of both the fixed income and the equities market, and also on the financial service industry. So here's a question from one of our guests. He's saying, I noticed you recommended banking stocks, but the regulatory environment seems negative to the banks. He says, for example, the policy on interbank rates. So he's wondering basically why you're recommending banking stock. I don't know if you got the question.
Yes, I got the question. So, I mean, we know that it is true. I mean, the investor who asked that question is very right by saying that the regulatory environment in Nigeria within the banking space is very, very tight. And it is not something that we are oblivious of. We are very much aware of that. But at the same time, when you look at the Nigerian equities market holistically, and you look at performance across different sectors, then when you take a dive into specific companies as well, and you look at two major sources of return for equity investors are, capital appreciation and dividend yield. So when you look at dividend yield, for instance, you would see that the top performance are usually banks. You could get double digits dividend yield within the banking sector. It is not something that you get very much, often in other sectors. So that is one way that I think that is one of the things that one source of income, one source of returns for investors, for those who invest in the banking sector. Another thing is when you even move away from where do these banks generate their income from? How do they generate the income that they even part of which they pay as dividend? Despite the stiffness of regulatory stiffness in the sector, banks have always found a way to shield themselves from whatever is happening, both in the macro environment and even within the regulatory space. So you would see that even when everywhere was, recording negatives in 2020, when we had that pandemic and all of that, banks still came up top. Financial services, industry generally still came out fine, finished the year strong. So this just shows that these banks are, resilient in terms of driving earnings. So those are some of the things that have informed the the recommendations for for the banking sector.
All right, thank you, Damilare. Great insights. Abdul Latif, I think this is for you precisely. Oluwatosan is asking. He says, what would you say, yes, currently now looking at the current trend within the last 3-4 days, what would you say is the cause for the continual drop in the MTN share price? And are we looking forward to the prices going up? If so, what will be the driver for that? We've seen how MTN shares plummeted. Yeah, go ahead, please.
Thank you very much for the question. So for MTN, we have seen a decline in share price recently, particularly specifically, it has lost about 20% in the last 10 days. And if you look at the broad market, really, the performance of the broad market during the same period hasn't been very positive either. The broad market also has lost, I think, about 4% during that same period. So we are the profit taking on MTN that we have seen in recent times is not just particular to MTN. We have seen that profit taking on tickers across sectors, really. And these are mostly tickers that we have seen a good appreciation on their prices in recent times. So what is definite is that whatever sell-off is being witnessed on MTN right now is in no way linked to their fundamental performance, really, because fundamentals remain very strong. We expect revenues to hit 2 trillion this year, and we even expect their profit after tax to do above 350 billion also. That translates to an earnings per share of about 13.6. And our tire price is also about 237 naira. So that's what we see the stock ending as our tire price for this year. So whatever is causing that sell-offs in the market is not linked to their fundamentals. Fundamentals still remain very much strong, and we note the likelihood of a rebound in the share price of the stock. Thank you very much.
Great, thank you, Abdul Latif. Thank you, Abdul Latif. Damilare, I think this is for you. Yeah, this person is saying here, with the incessant increase in policy rates in developed countries, do you expect a significant capital flow reversals in the second half of 2022? And it's also saying, secondly, where do you see the USD exchange rates and what implications would that have in the capital market? Did you get that?
Yes, I got that. Well, I would say that one, this question started from, do we see a possibility of capital flows reversals? My colleague Mosun mentioned it earlier that it is not something that we are so much. I mean, the risks here are heightened. We are going into an election period, and we do not see that possibility of inflows of funds into our domestic economy. But then when you say reversal, I would mean that, I'm thinking that you mean flow of funds away from Nigeria to those advanced economies. We are already seeing that, and that is something that has been happening since 2020. So it is not something that just started now, right? So in our equities market, for instance, we don't have a lot of foreign participation anymore. As in Q1, the average participation in the equities market is just about 20%, sub 20%. So, even if there's that reversal of funds, there's still the bit of how do you repatriate the FX that you have. In terms of the FX is very short. As at October last year, the World Bank's data shows that Nigeria's backlog, that's CBN's backlog for FX, is about 1.7 billion USD, and there's no hope in sight of how do we even repay that backlog. Of course, I mean, they said that the CBN is likely to pay the backlog in September, but when you look at the demand, the pressure on exchange rates, and the fact that there's not much accretion to our FX reserves, we see that, I mean, what we think is that it's not likely that the CBN is going to allow that huge volume of FX to leave the country, suddenly like that, because it's going to further affect our exchange rate. So I don't think there is even that room for any capital reversal. In the first place, the foreign capital that we have is not even as much. In the second place, even if you want to take out your funds from here, there is no much USD, in the market for you to use to take out your fund. So I would call on my colleague Mosumola to speak further to that and the question on exchange rates.
Okay, Mosumola, just speak briefly on that.
Okay, thank you, Damilare. Please, can you hear me? Hello?
Yes, we can hear you, Mosumola. We can hear you clearly.
Great. So in addition to what Damilare said, I mean, we've started to see that capital flow reversals already happening since Q1 2022. And even from the capital importation data, we saw that as at Q1 2022, our capital import fell to its 5-year low of $1.57 billion. So just saying that now that we're expecting more aggressive rate hikes in countries across the globe, we should also see more of that capital flow reversals happening for the second half of the year. And another thing to note is that for foreign investors, just like Damilare mentioned, one major thing that we would like to consider is the FX liquidity in the domestic space. And I think that that's really an issue. It's a concern for most of these foreign participators. So, and that just links closely to the next question on exchange rates, that yes, was our position on exchange rates. And just like I alluded to in the presentation, we are seeing exchange rates at the official window range between 425.66 Naira to the dollar to 515 Naira to the dollar. That's bear case scenario, 515 Naira to the dollar. So our base case scenario is that our exchange rate will be pegged at 438.66 Naira to the dollar. And some of the things that we've considered is the low accretion to external reserves, especially feeding from the high payments of petroleum subsidy bill and our low crude oil production volumes. And we've also considered the fact that there will be higher demand, so higher demand pressure on our FX, especially with regards to the upcoming general elections. And at the parallel market, we decided to see there was news yesterday on dollar to Naira to the dollar skyrocketing to about 710 Naira to the dollar. And I mean, the reasons are not far-fetched. While they are fundamental drivers, they are also speculative drivers. So on the fundamental side, there's higher demand. We have increased migrators. So according to the data as of Q1 2022, professionals that are migrating, even students that are migrating to other countries are now triple-digit percentage. So which then shows that there's a higher demand on this FX. And concerning speculative measures too, there are speculations, from these investors that there will be further rise in dollar. And that's why we are seeing that rise in the parallel market. So, I mean, overall, we just expect that there will be an increase in the exchange rates in the for the rest half of the year. Thank you.
Great, great. Expected increase in exchange rates for the remaining half of the year. Thank you, Mosomola. We have a raised hand here, so I'd like to call on Olushola Ojeni to please ask your question. You can go ahead.
Thank you very much for the opportunity to ask this question. And thank you to the team from Meristem for giving this insight and the review of the first half of the year. My first comment is on what Damilare mentioned earlier pertaining to Wema Bank. He mentioned that probably Wema Bank concluded the issue in the first half of the year. I think what they did was just the conclusion of the share reconstruction. And what the company said was that third quarter of this year is when they'll be looking at coming up with their right issue. Maybe you may need to reconfirm that position. That is the first thing. Then my question now is on the banking sector too. I think that also goes to him. We have Fidelity Bank being announced to take over some disco. What implication and what are the effects of this? Because I noticed that Fidelity Bank is one of the recommended stock, which they expect that is going to perform very well in the second half of the year. What is the implication of that for the valuation of the Fidelity Bank and their NPL ratio? That is number one question. The second question is with regards to FBNH acquisition of Access Pension. I think the value of Access Pension is not so significant compared to what First Pension currently has as the assets under custody. Would that really have much of impact in terms of their non-interest income, because it was actually stated to be one of the driver of that the growth and what will impact the value? I think those are the few things I have to clarify and to ask. Thank you very much. Thanks for the great insight. Over to you.
Okay.
Yeah. Okay, go ahead, Damilare. Go ahead.
All right, thank you very much. So the first question on Fidelity Bank, for now, we've not, that's something that has been announced about, their plans with the discos. And if that goes through, really, it is going to, we know that we have a lot of challenges with the discos, and it is a bit surprising because we privatized sometimes back, and there was so much hope that after the privatization, there's going to be more efficient management of that sector. But that didn't happen. But one thing that we know that for banks, it's very much, if that deals go through, right, it is very much likely that there's going to be improvements in terms of, because the banks is going to be, Fidelity Bank, for one, is going to be more concerned about what is the value we can get from it. Nobody will go into that. No bank will go into that kind of deal without being sure of the value. There are definitely uncertainties that would impact the actual from what was expected, definitely. But in terms of how that would affect their NPL, I don't think that would have much impact on their NPL negatively. And the reason is, even currently, we have a lot of banks that are exposed already to, that have exposure to this, both oil and gas firms as well as discos, right? So particularly here we are talking to discos. So if currently what we are having is banks just having loans being doled out to those discos, and that is not so much affecting. So when they are fully, involved in that sector, I don't think it would have much of a negative impact. And I think it is going to be one major value driver for them. We've not factored that in from our own perspective, because some of these things you cannot really be sure until you have there's not much yet to how the transaction is going to take place and so as to inform our own expectation of how it's going to affect valuation. But if it is something that eventually goes through, that means it is something that is passed by the CBN, but CBN also would have to, give approval for such a move by any bank to protect depositors' funds. So if there's something that sees the light of the day from the regulatory perspective, I think it's going to be a good value driver for them. The second question was on the first bank acquisition of the Access Pension. Yeah, so this is just that there are different, ways by which banks are trying to earn more non-interest income. Yes, the value is not so much. The same thing about Fidelity, FCMB last year, so the value of some of these pension, if you recall, FCMB also acquired a pension, a pension fund last year, sometime in 2021. And when you look at the relative value of those, businesses being acquired to the large pool in terms of from a group perspective, it seems to be insignificant. But the major way where we think of the value being coming from is through synergy, right? So when you look at what is the likely cost synergy versus what is the revenue that is likely to be accrued from there. So at the end of the day, really, might have a marginal impact on bottom line, but this is, for me, I think of these things more as a long-term play, right, than a short-term play. So as the group expands, they get more businesses for some of those subsidiaries that seem very, very small currently. So as they expand, all of those things expand with them, and they have more cost synergies, and that trickle down into the bottom line and what they return to investors as dividends. So I think these are some of the places where we look at to determine the likely impacts of such an acquisition.
Great. Thank you, Damilare. Thank you so much. And I trust that this answers your questions. Thank you so much for the question. Okay, one very important question here, and I'd like Kelechi to speak to this. Kelechi, we understand how important the oil and gas industry is to our economy, and we've seen some of the implementations of the recently passed PIA, right, the Petroleum Industry Bill, which has now become an act, and we've seen the commercialization of the NNPC. Now, the question is, should we be expecting anything special from this commercialization of the NNPC? And if we should expect anything special, how soon should we begin to expect the dividends of this, particularly for the oil and gas industry?
Okay, thank you very much, Umoife, for that question. So, coming from August 2021, when the PIA was passed, part of the PIA was that NNPC become, after 6 months of passing of the bill, now act, the NNPC should become a limited liability company. And what that means is that NNPC would have the opportunity to, be listed, or do an IPO, and by that, we can see the public sector investing in the company. But then it's still not clear. Based also from the PIA, we've seen that 3 new regulators have been established, where we have the minister, and also we have the upstream regulator, and also the midstream and the downstream regulator. But then it's still not very clear where the NNPC plays a part in. We've seen that regulation has been shifted away from NNPC. But then when we look at the downstream sector, where we have, previously when NNPC was a regulator, we also see them play in that field. And currently we have NNPC as the sole importer of for our PMS product. And this is because, unlike other downstream players, the issue is that many of them are not able to get FX at the official rate. And then if you want to import using the parallel market rate, that would be, in negative for you, because we have the PMS product being capped, and so you probably be importing at a loss. So there's still some kind of discrepancy or unclarity about how things will go in that area. And that's why we are waiting for the deregulation of the sector, which the PIA stated that the deregulation of the sector should happen upon the passing of the bill. But then we've not seen, that happened recently. And I mean, we can say that is because, we know what deregulation would do we already have inflation rate at about 17%, and this is still at PMS prices at most 170 naira per liter. So if you're looking at the deregulation, we're seeing PMS prices go above even 250 or even reach 300 naira per liter. So that can't really happen. So it's still, but then what are the benefits? The benefits is that, we don't know when the NNPC would, go public, but then the information that we've heard from the manager of the firm, the MD, is that we're looking at it happening in nothing less than 3 years' time. So after 3 years, probably we'll see such listing occur. But then in terms of operation of NNPC, as against how the company operates with other counterparts or with its peers, especially for the downstream side, it's still really not clear in that area, because it's now an advantage, being the sole importer of a product, so there's going to be a lot of competition in that area. So a lot of clarity is still, or will I say there's still some fine tuning to a lot of things. And, when that happens, then we can now give a more informed outlook on that.
All right, thank you, Kelechi. Still some fine tuning needs to be done, hopefully within the next 3 years. Great, thank you. I think it's been a worthwhile discussion. I'd like to take one last question, and thereafter we'll be rounding up this conversation. And I think this is directed to Abdulateef Grillo. Now, Victor is saying, looking at the sector performance in H1, right? We've seen the oil and gas sector perform impressively. So Victor is asking, which sector will be your top picks for H2? Abdulateef.
So for the second half of the year, we have come up with fundamentally sound stocks, which we are very bullish on for the second half of the year to perform very well in the equities market. And those stocks are contained in our equity, in our equity strategic portfolio. These sectors were selected across, these stocks were selected across sectors in order to form a balance of the portfolio. So I think the portfolio was displayed when Damilare was having his presentation, and to also be contained in the presentation slides that will be sent out to all clients. Thank you.
Great. Thank you, Abdulateef. Distinguished ladies and gentlemen, we'd like to say thank you once again for joining us on this special webinar on our outlook for the second half of 2022. It's been an interesting conversation. We trust that we've been able to provide some level of insight on what we should expect for the second half. In case you joined us late, you can visit the chat box. We've posted a link to the hard copies of this of our presentation. You should click on that and study that at your own quiet time. And so, to give life and further breath to this conversation, I'd like to call on the Deputy Group Managing Director of Meristem Securities Limited, and that is no other person than Suleiman Adedokun, to give us a rounding up speech for this conversation. Dear Suleiman, can we have you please?
Okay. Thank you very much. Good morning, distinguished clients and prospects. And thank you, Taija, for that wonderful coordination. And I really like to appreciate the research team for this insightful presentation. It's really quite interesting because it speaks to the time that we are in. And really, if you look at the title of the presentation, Unearthing Value in an Unending Crisis, really, we are in crisis. You know, the environment is getting terrible with so much of volatility globally and locally too. We have witnessed a lot of uncertainty and risk, and everything is becoming more complex than anticipated in different areas. And I think this has been highlighted from their presentations. The inflationary pressures, the exchange rate issues, that is worsening situations by day. Everybody is feeling the pains of this. The physical deficit, the debt profile of the sub-Saharan countries, especially Nigeria and other countries like that. And also when the supply chain issues driven by the Ukraine and Russia war, these are global issues that have affected us locally. And in all of these, the question is, what are the strategic response pushing election year 2023? And security issues has become more of a challenge. In all of this, again, what we are witnessing as investors, as clients, most of the investments, they're in the realm of negative yield. Negative yield because most of the returns you get most of the time, they are below inflation, they are below inflation rates, as mentioned, about 18.6%. So there's a need for us to look at this, and which I think the team has done, a good justice. So again, I thank you, Damilare, thank you, Juliana, thank you, Mosumola, thank you all of you guys that have done wonderful analysis, and we quite appreciate you. And you know, the question is, why do we have this presentation? Why is this very important at this time? As I said earlier, it affects our portfolio. It affects the level of our wealth, because from the macroeconomic variables presented, this is actually eating deeply into our financials. It's eating deeply into our wealth status. It's eating deeply into our plans, financial plans. Many people plan to retire at different areas, at different times. And these macroeconomic variables, they're actually affecting the plans. And so there's a need for a strategic responses, strategic approach towards dealing with this. And that's why we are here today as Medicine, to give this a life so that we can all appreciate and think deeper than what we have done before on how do we respond to this? What do we do? How do we manage asset allocation in a way that responds dynamically to the situation we find out, the situation of our finances? And this is why every client needs to take action now. As so much of strategic responses that we all have, the more we respond dynamically to situations, the better for us. We want to protect wealth as a firm. We want to protect our clients' wealth to ensure that those wealth are preserved for the next generation. We want to protect the portfolio. I want to be able to do this with provide information to our clients. And I think this is why we are here, and that's what we have done this morning. The team has done this morning. As a company, Medicine, our brand promise is to provide up-to-date market information to grow wealth in good time and in an atmosphere of transparency. It destroys when you don't have people to help you, to provide you with the information. And this is not the time to actually destroy value, because values, most of the clients, nearly all the clients, they've earned the portfolio. They've worked harder to build those portfolios, and we must hedge against risk. I appreciate most of the analysis done by the analysts. I appreciate the insights about sectorial performances and how we need to position ourselves in those sectors. I mean, strategic allocation of resources to portfolio, to sectors specifically. Aggregate return may be 20%, 25%. Your portfolio may do more than that. It depends upon how you respond and how you find help through advisors.
This is a time that we need to engage with advisors on a continuous basis. This is a time we need to deepen our relationship with our clients and our advisors so that we can continue to monitor the portfolio and respond to it. At what time do we shift the portfolio to alternative investments? At what time do we shift the portfolio to other investment, other asset classes? These are very important activities that we need to do. In fact, now it's a time for active monitoring of the portfolio so that we don't just invest and sleep. I also appreciate one of the questions raised today, fundamental questions, insightful questions that the team has also dealt with. The key takeaway for us is not about what I've been said here. There is portfolio planning and there is portfolio execution. We've planned, we've reviewed this asset, we've reviewed the environment, we've looked at what is happening globally and locally, and we need to now take action. Take action on our portfolio, do more portfolio review, and let's act on the portfolio. The information provided by Meristem is to provide a guide and also to be able to act with our clients. We respect so much deeply our clients and their objective, and we are here to really ensure that that objective are actualized. And that's why we're in business. We thank everybody that has contributed to this presentation and really appreciate the participation of every client and prospect. We believe that we'll be able to do so much towards helping you navigating this unending crisis as I've been detailed. Because to us, it may be a crisis, but we believe there are so much opportunities that we're going to tap into. It is your ability to look at opportunity of this crisis and challenges and take opportunity within those challenges and make and increase the value that we have created for ourselves. So in closing, I'd like to thank everybody that participated, thank every analyst that have presented brilliantly. I appreciate you guys. And also thank the coordinator, Tiger Murphy. And we believe that by the time we have our next presentation, we will have good story to tell ourselves, that we have responded dynamically to what we presented. We have really made money from it. Thank you very much. And I wish ourselves and the entire commission, this uncertainty, this complex environment, with so much of benefit that we add value to all of us. We pray that we're able to, that our leaders be able to address the exchange rate issue that we are facing that is biting everybody continuously, and in a way that it will be a benefit to all of us. We all need prayer in this country to drive the macroeconomic variables that we are witnessing that are not so interesting to a positive end. Thank you all, and God bless.
Amen. Thank you, Suleiman. Thank you, everyone, once again. At this point, we want to say, have a beautiful day and a prosperous second half of 2022. Bye for now.
Everyone needs a body. Now you have one. Introducing Wealth Buddy. Save, invest, and pay your bills. Now you have a buddy to help you reach your money goals, uncover attractive investment opportunities, and make payments with the press of a button. Here's how it works. Saving on the Wealth Buddy app is superest. Ensure you are logged into the app on your mobile device. Then head over to your savings dashboard. Click on the plus sign to see a list of savings options to choose from. Add your goal details and start date. You can also add a photo to personalize your goal. Choose to fund your savings plan from your debit card, and then you're all set. There are several options to choose from when you invest with the Wealth Buddy app. Head over to the investment dashboard. Click on the Add Investment button. Select on the Create Investment option. Choose an investment option from the list. Read all the information, then click Invest at the bottom. Fill in the required information. You can also add a photo to personalize your investment. Choose to fund your savings from your debit card or your wallet, and then you're all set. You can also pay your bills conveniently directly from the Wealth Buddy app. Go to the wallet dashboard and select one of the bill's payment options. Pick a bill you want to pay from the drop-down. Fill the relevant details and choose to pay with either your debit card or your wallet. And just like that, you're all set. Start your journey with your new body. Download the Wealth Buddy app on all iOS and Android devices today.
You've reached the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem. Let's grow wealth for you.
Yes, I just paid my children's school fees. Supposed to buy some shares today, but it's school fees season, you know.
But just like school fees, stocks cannot wait. Life's many responsibilities come with its sacrifices, but with the margin lending facility, you don't have to miss out on your investment opportunities. Now you can buy shares even when you are not liquid. All you need to do is have existing shares, managed funds, or cash to be used as collateral. The marginable stocks will be calculated to determine how much you can get to buy new stocks. Remember, there is no investment without risk. The time and stocks wait for no one. Don't imagine what can be. Let the Meristem Margin Lending help boost your investment portfolio. Terms and conditions apply. Call 0700 Meristem now to get started. Meristem, let's take you further.
You've reached the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem. Let's grow wealth for you.